Everybody knows about backdoor Roth contributions, but why is everyone screwing it up? Hey everybody, before we start this episode, a quick shout out to our sponsors. Today's episode is brought to you by The Perfect RIA. How could it not be brought to you by The Perfect RIA? But if you enjoy these episodes, if you think that Micah and I, or at least Micah, have some great advice to give, head over to our website, theperfectria.com, and download one of our free guides towards making your practice better. So it's not just the things you hear on the podcast, it's the things that you implement. And if you're saying, you know what I'd really like to get in a room with Matt and Mike. I'd really like to ask them my own questions. I'd like to be coached by them. Then send an email to lifestyle@theperfectria.com, and one of our great team members will reach out to you and tell you more about the program. Hello, everyone, and welcome to another episode of the Perfect RIA podcast. I'm your host, Matthew Jarvis, and with me today, special guest, someone I've known for a long time. You may know him as Steven Jarvis, head CPA of Retirement Tax Service. I know him as my brother, Steven. Steven, welcome to the show.
Well, Matt, thanks for being here. On my list of things I'll never catch you at, you've known me for your entire life. I've only known you for... Or no, other way around. You've only known me for most of your life. That's right. I've got this one on you. I've known you for my entire life. So
that's true. That's a good point. So yeah, Steve and I have known each other for a long time. Basically our entire lives. We obviously grew up together, but several years ago, Steven agreed to leave corporate accounting, where he was a master of that domain, and he came over to work with financial advisors because we said, hey, there's this massive deficit of tax planning for advisors, not tax noise. There's plenty of tax noise. There is very little tax advice where advisors can say, and we're going to talk about 8606 today, Backdoor Roth. How do I actually use this with clients? And of course, Steven, you've built up the entire Retirement Tax Services Network, the Retirement Tax Summit, the podcast, all of that great stuff. So really glad to have you, not just on the podcast, but in the industry. Much needed.
Well, I appreciate the invitation. The way I explain this to people, and I'd be curious how you remember it, the phrasing I remember is, hey, Steven, we can't find CPAs who will play nice with us. And my initial reaction to that was, guys, this seems like a really simple thing. This has to exist. And you basically said, great, go find it and we'll leave you alone. And it didn't exist. And it's still a little bit mind-blowing to me that it's so hard to find financial professionals in these two different, clearly parallel industries that will talk to each other and play nice with each other and work together to benefit a client.
Yeah, quick reminder for advisors listening: when you get Steven's bill for working with him or for joining his coaching program, remember that the reason that bill is what it is, because if you can find a cheaper option, like, please call me. Steven's my brother, but I'm still running a business here. If you can find a cheaper, better option, I would love to see that. Well, Steven, joking aside, let's talk today about a tax strategy that we're going to call that everybody knows, but almost no one implements correctly. Yeah. So yeah, in addition to obviously being a CPA, having a deep tax background, you prepare or review hundreds of returns, thousands of returns a year. And so you see these returns coming through correctly, and you see a lot of them coming through incorrectly, even though, quote unquote, everybody knows the Backdoor Roth strategy.
Yeah, so Matt, anytime we bring on a new client, the first thing that we do, regardless of their situation, is we ask for the last 3 years of tax returns. And we have a checklist that we go through. One of the things we're looking for on there is the 8606. And in addition to that, we're looking at line 4A and 4B on the face of the 1040, because especially as we look at clients who might be a good candidate for a Backdoor Roth contribution, we want to see if it was done correctly. And that, as far as volume goes, that's the single biggest source of amendments that we do for new clients, is going back and identifying, hey, someone tried to help you do a Backdoor Roth contribution and it did not get reported correctly. And to the point of where RTS came from, my experience is that the gap is that communication between the two parties, that the advisor was usually well-informed and certainly well-intentioned, but did not take responsibility for seeing it through to the reporting to the IRS, which is a critical step. It doesn't count if it doesn't get reported correctly. In fact, it's the opposite of helpful, because a lot of times you're going to now get your client double taxed.
No, I think at this point of the episode, right, advisors could probably split into two camps. There is one camp, and no disrespect to this camp, that's saying, wait, 8606, Backdoor Roth, cream in the coffee, what basis, reporting IRS, what does that even mean? To those advisors, great news, two valuable resources. One, just a little bit ago, Steven, you and I wrote an article for kitsis.com on how to do Backdoor Roth, so that's a great resource. The second one, which I think is far more valuable, you recently released an entire masterclass on Backdoor Roth, which for the second group who's saying, oh yeah, I already know this, I'm almost willing to bet. In fact, I'll even bet a beer on this one. If you see me at a conference and you watch the masterclass and you don't get anything for your practice, like, I'll buy you the beer. But that masterclass is full of step-by-step. How do you articulate this to the client? How do you articulate it to the tax preparer? How does it get reported on the tax return? How do you then check when you see the tax return. So this is a process. It's not just let me send $6,500 into the custodian and call it a day. There is an entire process that needs to happen. Or for your own protection, just say, listen, I'm just not going to do that.
Yeah, and while I love all the tactical things, and those are certainly in there, I'd also highlight, and you might have mentioned the communication piece, because one of the things that will happen for each taxpayer, it's only just $6,500, and this is usually most relevant for high earning individuals. And so some people might say, and that you're spending a whole episode, you recorded a whole masterclass, like this is complicated. Let's just ignore it for $6,500. But this is how we kick the thing off is let's talk about what this means over time, because for the vast majority of your clients, even for the vast majority of advisors, the best tax planning is the simple things over time. It is not moving to Puerto Rico. It is doing these consistent things over time, like backdoor Roth contributions that sure in 1 year might be $6,500. But if we're married, that just became $13,000. Yep. And we can all do math times 10. So now that's, well, help me, Matt. It's $130,000. Yeah. And then, this is something we can do for decades if we catch it early. So now we're talking about 6, if not 7 figures with growth of tax-free money. That's my favorite kind of money.
As I always mention to clients, and by the way, when I say always mention, I mean like literally in every client meeting, I'm having the discussion, Mr. or Mrs. Client, someday you're going to need a lump sum of money. And I really hope it's for something fun, like you're going to buy an RV and drive around the country. Or it could be for something not fun, like you have emergency medical expenses, long-term care, et cetera. In either case, we're going to be incredibly grateful if we have a pool of money on which taxes have already been paid and we can pull that money out without getting killed in taxes. Steven, I have that discussion in every single client meetings as we transition into Roth. Then we're talking about backdoor Roth or Roth contributions or Roth conversions, or even just like, Mr. and Mrs. Client, by the way, we already done all the Roth conversions we want to do. We're not going to do any more, but great news, you already have this bucket, right? I'm applying the dishwasher rule. So this is a discussion that happens for almost every client.
Yeah, I like your approach to that, Matt. The way I phrase this to people is that everyone should consider Roth every single year. And consider is an important term in there, because you can have all the philosophical debates about pre-tax versus after-tax, but having a tax-free bucket is so powerful, like you're talking about, for those one-time expenses, those lump sums that we can't anticipate, that it is worth considering. And I definitely work with clients where in a given year, we say, hey, you know what? Doing more Roth this year isn't the right answer. We've got a couple of years here where we know you're getting close to retirement. You've got some severance that's getting paid out, whatever it might be. These are your peak earning years. Let's lay off Roth for a couple of years. But in general, anytime I can look at it, and I do the same thing for myself personally, which is why I feel so great recommending this to clients, I'm going to look for every opportunity to get money into Roth and take the IRS out of my picture.
Yeah, I really like that. So, Steven, let's talk about some common mistakes that are made here. And again, I know there's entire sections of the masterclass. We talked about it in the Kitsos article, but let's talk about some of the common mistakes here. And these ones are easy to get. And we aren't mentioning these to beat up on people. I'll be honest, I've made these mistakes in the past and had to clean them up. So in no particular order, one that comes from mind to me is reminding that the 8606, which is where what we're calling backdoor Roth is reported, looks at account values on December 31st. Not the value of the account when the client did the conversion. So here's where this bit me several years ago. Luckily, Steven, this was when we could still do Roth recharacterizations. I was able to fix this one. The client had been doing backdoor Roth contributions. We converted it. They retired later that year. We rolled their 401k over to an IRA, go to fill out the 8606. And instead of zero for a 1231 balance, it was like $2 million. It blew up the whole strategy. And we'll talk about cream in the coffee. Again, thankfully, that was pre-characterization, so we were able to recharacterize that conversion and fix it separately. If you did that today, if in April you're doing that 8606 and the 1231 balance was different than you thought it was going to be, that's just game over. Like you're out of luck there. Like you've messed that up. And what you've gone from telling a client this is a tax-free Roth conversion, now they owe tax on some, most, essentially all of it. You got a big problem there.
Yeah, big problem. And there might be people listening thinking, okay, well, that's the exception. How often can that really happen? And so let's talk about some things that I see happen all the time.
Yeah.
And let's keep in mind that anytime clients have a say in what goes on, there's a chance that this is going to get messed up. But one I see all the time. So we got to remember that a backdoor Roth contribution is not a single step. Right? There's multiple steps in here. And so we do a non-deductible contribution to an IRA. Then we do a distribution from that IRA and then a contribution to a Roth. That's really how the conversion works. And so when we do the distribution, that generates a 1099-R that without fail, regardless of your custodian, that 1099-R is going to have $6,500 gross, $6,500 taxable, and then that box right below it that I hate more than anything says taxable amount not determined.
Yep.
again, by every custodian. And I don't think the custodians listen to this podcast, so I'm not going to harp on how I think they should fix it, because they're not going to. So as an advisor, you need to deal with this anyways. And if that goes to a tax preparer, 99 times out of 100, they're going to just type in $6,500 as taxable and they're going to move on, because they're doing this in March and April. They don't have time to think about it otherwise. And no one told them any different. And so this is where you have to be so proactive. That's probably the number one place we see amendments needed, because then it was a non-deductible contribution. You already paid tax on that $6,500. And then you're going to report it again on line 10 or 4B of the 1040, and you're going to get taxed on it a second time. That sucks. Now you've paid, 60, 70, 80% tax on that $6,500. So that's when we go back and amend, which is its own mess, because you're probably paying for that amendment. There's the time delay, there's the confusion, the chaos, all of that.
Yeah, there really is. It's also important to remember that there's not like a box to check for a non-deductible contribution, right? There are IRA contributions, and then later it's determined if they are deductible or not. So like when you're sending it in, you don't check a box, oh, this is a non-deductible, right? So it's going in as a contribution. So again, this is where we see a confusion come in. On the 5498, it says contribution, $6,500. It does not say non-deductible contribution. It just says contribution. So again, if someone's just typing in the numbers, tax preparer, the client themselves, whoever it is, and they're just typing in numbers, it's not necessarily going to work.
Yeah, another thing that comes to mind is when we accidentally create basis. We're not doing this on purpose, and we crossed an income threshold, or we didn't understand the client had access to a 401k plan through work. Some of these different kind of overlapping rules where we could inadvertently, we could think that we're making a deductible IRA contribution, and then realize at tax time, oh wait, no, in fact, I don't get a tax benefit, which most likely the tax software will flag for you.
Yeah.
But then what inevitably ends up happening is we don't realize that basis is in there. And then when it gets distributed, we're just going to pay tax on it in the future because we didn't track it and take care of it appropriately.
Another place I see this come up, Steven, and this is where we want to watch carefully, when clients change tax preparers. Because 8606s are not consistently filed. As best practice, you want to file them every year if you're carrying forward basis in that IRA. But sometimes if there's no activity, they don't get filed. The client gets a new tax preparer and the basis disappears because it didn't show up on last year's tax return. This is where we, again, as advisors, when we're working with clients, we want copies of those tax returns year after year. We also, for prospective clients, want the last couple of years. And then again, if I'm getting a new client and the tax return does not show an 8606 and they have an IRA balance that they've been contributing to and they've had a history of high earning, that's a warning for me of, hey, listen, these people might have made non-deductible contributions. We should go back and see if we can track down some of that basis, which can be a bit of a treasure hunt. It can be tricky sometimes to find.
It definitely can be. There's a huge value, like so many things in life, there's huge value in doing this right the first time as opposed to trying to go back and clean it up later. Because again, this is one of those frustrating things to me where the system isn't even set up for success, because those years you're talking about where the 8606 doesn't get filed, that's not even technically a mistake. It's not required to be filed. Yeah. And so I'll get that question all the time of, where can I see on the tax return what my non-deductible basis is, or what my Roth basis is, or any of these things? And it's like, no, that doesn't get tracked year over year. We want to report it so we have the paper trail, but best practice is that you're also tracking this for clients so that you know where things are at, that whether the tax preparer is filing the 8606 every year or not, that you can be that knight in shining armor for them to say, oh, wait, we need to think about this as we're distributing it because we've got some non-deductible basis in there.
Yeah, a quick reminder there is no statute of limitation on audits for basis, right? So if you're getting audited and the client says, oh, I have X in basis, the IRS is going to say, great, show us where that basis was established. And if you say, well, look, it's on my last 3 years tax return, they say, well, we see that you reported it. Where was it established? I literally sat through an audit where this happened and the basis had been established 20 years earlier, or excuse me, not 20 years, 13 years earlier. And the IRS says, girl, you got to show us, so we're going to assume that was all made up. And luckily, we had copies that the client had long since got rid of it because they thought, well, 3-year statute of limitation. I don't need to keep this stuff. Turns out you do. Another place, Steven, I see common misunderstanding here, not with advisors. I think advisors are pretty good at this, but sometimes clients are doing non-deductible contributions and they think they have a separate IRA account. So they say, oh, I have my IRA account for my pre-tax and I have an IRA account for my after-tax. That does not, in fact, exist. The IRS says, hey, what is the balance of all IRA accounts on 12/31?
Yep. Traditional SEP and simple IRAs all get lumped in together. You briefly mentioned cream in the coffee earlier, this idea of how can we potentially avoid the pro rata rule. And so there are ways to go about that. If we can get all of our pre-tax dollars into an ERISA plan, into like a 401k or a 403b, then we can go ahead and convert the non-deductible basis to Roth. But there's confusion here because a lot of times people will think of, oh, well, traditional IRA stand on its own. Nope. Even with the expansion of Roth options under Simple and SEP with Secure 2.0, those are still all lumped together as far as the IRS is concerned.
Yeah, there's a lot of interesting pieces. We just this year helped a client separate the cream from the coffee, right? So they had pre-tax and after-tax money in their IRA. As you pointed out, you cannot withdraw just the after-tax money, just the basis. That cannot be withdrawn on its own. You can, however, if you're rolling into an ERISA plan with a lot of rules being met, pull out that pre-tax amount. But there are a lot of rules that have to be met. It can be pretty fraught with issues. So again, this is a thing where, and as you pointed out earlier on, this is a multi-step process. This isn't a Roth contribution, one-step process, basically. A backdoor Roth contribution is a multi-step process that should not be taken lightly, right? That's where, and I know in the masterclass, and I know you also had that recently in one of your newsletters, really a checklist to follow. If you're doing backdoor Roth, here is the checklist to follow all the way through to the filing.
Yeah, there's a lot of really important reminders in there. And then I just want to call back to even the beginning of this conversation that we talked about. That's why even to this advisor audience, we're talking about what the value here is, because it's really easy for us to go down this rabbit hole of, man, this is so complicated and so many mistakes happen. And it can almost feel like, okay, again, why even try? But that's when we got to go back to what are the goals we're trying to accomplish? And is this a powerful tool for doing that? Yes, it absolutely is. But we need to take the time up front to have a system and a process and a checklist. Whether you decide you want to spend the time coming up with that on your own or, learn from someone who's done it, but you need to have a plan, or not only is it not going to go right, you're going to end up with your client worse off than if they hadn't done it.
Well, yeah, you really will. And this is something, Steven, you and I talked about recently on the Retirement Tax Services podcast, which if you're not subscribed to that podcast, definitely do. We were talking about the RTS Tax Summit that was last year. Of course, the next one is coming up in September 2024. We're excited about that. But we talked about the importance of collaborating with other advisors, right? So you've heard this podcast, you've listened to, back to Roth, whatever the case may be. The most valuable thing is to talk to other advisors and say, cool, are you doing backdoor Roth in your office? Not have you heard about it, not do you know about it, are you doing it? Yep, I am doing it. Cool, how are you tracking that? And when they say, well, we're not really, you can just stop the conversation there. But if they say, actually, we have a 7-step workflow in Redtail, we track each step along the way. Really cool. Like, can you tell me a little bit more about that? So speaking of other affiliates and people that we're passionate about, want to do a quick shout out for our sponsors, right? This podcast is brought to you by several sponsors. So let's take a listen to those. Hey everybody, today's episode is brought to you by our friends at Belay. The best part of having a virtual assistant from Belay is not the things that they get done that you were already going to do. That is valuable, by the way. It's that list of things that, if we're being honest, you need to get to and you're just never going to get it done. Like that doctor's appointment you keep meaning to schedule, or the contractor you need to find for your house to fix that leaky thing, or the flowers you keep meaning to send to your wife. Those are all things that you can give your Belay virtual assistant so that they get done, because we know that, if we're being honest, they're probably not going to get done. Now, how are they going to get done? Because Belay finds virtual assistants, including my own virtual assistant, who are masters at working down task lists. They're masters at taking one step ahead of what you're already thinking, right? Reach out to Belay, text the letters RIA to 55123 to get a free copy of their ebook. More importantly, to get introduced to my good friend Teresa, who's going to see if you're a good fit for a virtual assistant. Not everyone is. And then find a virtual assistant who's perfectly matched to your needs. So text the letters RIA to 55123. And now back to the episode. All right, welcome back. Steven, again, we've been talking about backdoor Roth contributions. We've been talking about the 8606. Would love your thoughts, and I feel like this is a spot where advisors get in trouble here, is they're using some sort of financial planning software, we don't need to name any names, and it spits out a recommendation, do backdoor Roth, or whatever it spits out. How do we avoid falling into the trap of, well, the software said to do it, I should do it, versus, oh, I really get this, like I understand how this works, here's how I'm going to articulate it to clients. Just your thoughts there.
Yeah, I mean, tax is such a relevant and valuable topic that you're seeing more and more software in the financial planning industry add tax features. And I'll say that some of them I've been impressed with, some of them are really cool, but they're not to a point yet where you can trust them on their own. And even as I talk to the people who create these software, they'll echo that too. Every tool needs a good operator. So let's take this becoming a more common feature where you run a tax return through a piece of software and it spits out recommendations. That can be helpful to guide your process, but that is not the finish line. Because if you run a tax return through a piece of software it's not going to know what other IRA balances the client has. It's not going to know if they have a 401k where we can separate the cream from the coffee. It's not going to know what their next 5 years of income looks like. There's all these things that are missing that could be a good indicator. That might be a really fast way for you to narrow down. I've got 200 clients. Okay, I can run them all through, and these 30 are the ones maybe I need to focus on. And that might help shortcut your process. That it might leave out some people that you probably should consider it for anyways. But still, there's going to be other steps you have to take. That can't be the finish line, or we're going to miss things.
Another thing that comes to mind on that, Steven, you mentioned having multiple IRA accounts. This is another tool or angle I use with clients and prospective clients on why we have to manage all of the assets, right? So I routinely tell clients we insist on doing our best work, and we can only do our best work if X, Y, or Z, or in this case, if we manage all of the accounts. And if the client says, hey, listen, I want to have this side account and it doesn't really matter. Mr. and Mrs. Klein, I'm glad you would mention that. There are several tax strategies we employ that it does in fact matter. And if there's something going on in this other account that we're not aware of, we're not monitoring, it could cause a lot of problems. In fact, and again, if I was sitting with a meeting, I would say, in fact, I was just listening to one of the top CPAs in the industry, and he was explaining how he often sees cases where clients have other IRA accounts that they thought weren't a big deal, and it caused real problems on the tax return. Mr. and Mrs. Client, I want to make sure that never happens to you. Therefore, we're going to keep all the assets in-house.
So, Matt, as you say that, since you kicked off the episode with how long we've been brothers,
it's
a long time, I'm going to pull back the curtain for everybody listening here, and I'm going to make a confession. When I first started listening to your podcast and I would hear you say things like that, here's how I explain this to my clients, there was part of me that's like, Matt, you're just giving me a sales pitch. Like there's like this is some like pre-recorded thing. Like this sounds so hokey. Like I had those kind of thoughts going through my head. I'm just being totally honest.
Yeah.
Same thing when I listened to Micah originally. But then I started working with your guys' clients, and I would hear them say those things back to me. I would hear you guys say those things. This is not, you didn't like sit down and say, what would be clever? Like this is learned from a lot of experience. And while when we talk about it really fast on a podcast like this, it might just sound like we're giving you sales pitches. No. These are communication skills to help clients take action and to follow through. This isn't about pulling the wool over somebody's eyes and throwing something past them. These are real things that will make a difference. And there is that really important integrity piece of I'm doing these things, I'm communicating these things, I'm looking for ways to level up, because again, I can tie it back to the value my client gets from this.
Steven, funny you should mention that. It reminds me of a story. A friend of mine called me one time in the industry who's talks to a lot of advisors. And he says, Jarvis, you wouldn't believe this. I just talked to an advisor from whom you took a client. And I said, really, who is it? He said, well, I'm not at liberty to share that. And I'm like, well, I'll go back and look at my notes. I'll probably figure that out. And so this friend of mine, again, we'll call him Bob. He says, yeah, I was talking to this advisor, and he said that you told the client to say, hey, I'm trying to think of all the lines, but like the client was repeating all these lines that I told him to use, right? Because I said, for example, like, hey, you can go back to your advisor, and they might say like they were aware of that, but just ask them why they had never shared that with you before. Here was the one they used, and I use this every time. Great news, Mr. and Mrs. Prospect, right? If we decide to work together, there's no long-term commitment. Like you could literally tomorrow say like, Matthew, I'm done. I don't want to work together, right? But at any point in the future, if you ever decide, hey, Matthew, you've done all of the great work that you can, and we don't need to pay you anymore, or we want to go back and work with our other guy, great news, I'll help you and we can part ways as friends. So they went to this other advisor and repeated. They told him, they said, hey, listen, great news. Matthew told us that if we ever wanted to come back and work with you, he would help us transfer our accounts back. Right? This advisor was fuming, but that is literally what I say. And to your point, Steven, like it can sound like it's this canned pitch, but it works really well. Like I went with my daughters to Broadway not long ago, and we saw Hamilton, and we saw Music Man, and we saw Phantom of the Opera. And I had seen Music Man and Phantom of the Opera before. And you know what, Steven? It was word for word the same. And I assume that Hamilton was word for word the same. And I bet they do it 6 days a week. I'm sure it's exactly the same every single day of the week, and people love it. Right? Sometimes we get this misconception of we have to make this novel and unique for each person. And for them, it is novel and unique. But for me, it's the exact same thing because it works. So sorry, that's a side tangent there. You need it. If you're doing complex topics or simple topics, you need a way to articulate them again and again and again.
Yeah. And so as we go through all these common mistakes, we're explaining this to an advisor audience. But I know when you work with clients, Matt, as I work with clients and these things come up, I set the stage for them. I don't go into this level of detail, but I set the stage for them to say, hey, it's called the Backdoor Roth contribution. That might make it sound like it's really shady. It's not. The IRS has approved this strategy, but it does come with a couple of extra steps. And there might be some places along the way where it might feel like something's gone wrong. But just so you know, we're tracking all this for you. We've helped lots of people do this. We always end up in the right place in the end. So if anything comes up along the way, because especially if they work with a tax preparer that you don't have an active relationship with, they might get pushback from their tax preparer and say, geez, your dumb advisor, Matt, he screwed this all up and, blah, 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 blah. And so now we're setting the expectation that this is going to be a little bit challenging, but I've got you covered. And now if something comes up, they're not surprised by it. They're not concerned by it.
Boy, the other thing that comes to mind, and we need to transition to action items, by me having the same way of explaining this every single time, my subconscious can take care of that, right? I don't have to have thought in a client meeting of how am I going to explain this. I can explain it without thinking, and I can use the rest of my brain power because this is a nuanced thing. There's a lot of moving pieces here, and I can process other things that are going on while I'm giving my dog and pony show, if you will, on how this works. So there's a lot of advantages there.
The other quick thing I'll throw in there, Matt, is it really helps your team. And I see this with advisors across the industry. Advisors who approach their clients the same way over and over again and use the same terminology and the same phrasing, their teams can operate at a much higher level because it takes the confusion out of communicating with the team as well as what the action items are, what paperwork needs to be filed. Everyone's speaking a common language and more value gets delivered.
Yeah, it really does. It really does. Well, being able to communicate it only counts for part of the thing. You have to take action on it. So I would say, Steven, action item number one, and you mentioned this already, Roth accounts, whether they're backdoor Roth contributions, conversions, need to be looked at for every client every single year. And according to the dishwasher rule, they need to know that you're looking at them and consider them every single year, even if it's a quick, hey, just as a reminder, as we do every year, we looked at Roth accounts, Roth conversions, Roth contributions. Doesn't make sense for you. We're going to look again next year.
Yeah, the next action item that goes right along with that to me is that you have to be getting tax returns from every single client every single year. Whether you're doing backdoor Roth contributions or not, there's too much that you do with a client that has an impact on the tax return. And so you need to do this so that you can be sure that your planning is getting reported correctly. And it's a great place to use the dishwasher rule and say, Mr. and Mrs. Client, we did X, Y, and Z together this last year. Here's what's coming through on this line and this line and this line. And we're going to do this again next year.
I love it. Next action item, if you're not already a follower of Retirement Tax Services, check out their podcast, join their coaching program. Be sure to go to the Retirement Tax Services website, download the desktop tax guide, which was recently updated again. I keep it on my desktop everywhere I'm at. I have it in my laptop bag everywhere I go. It is an essential resource. While you're there, be sure to also sign up for the Retirement Tax Services Summit that we're going to be doing in conjunction with the TPR Practice Management event in September of next year. Steven, any other pearls of wisdom or action items for our listeners?
Matt, you mentioned it earlier, but I'll just highlight it again. We did just put together this masterclass. Really appreciate that you and Micah did some guest spots on that, talking again about how this works from the advisor side. And this is an area where Google has the technical information that is not going to cut it. So whether you take the RTS masterclass or want to go find a different resource, you need to be doing something more if you want to execute this correctly for your clients. So again, retirementtaxservices.com, get signed up for the class. You can get your CE before the end of the year. Make sure we took care of that for you. But this is going to help you deliver more value to clients.
All right, everybody. Hey, thank you so much for joining us. Remember to like, subscribe, give us a 5-star rating. Stay tuned for a quick word from our sponsors. And until next time, happy planning. Hey, everybody. I want you to take a quick look around your office. And on your desk, there should be the Retirement Tax Services Desktop Tax Guide. And if it's not there, or if it's not current, meaning you didn't download it in the last month, go to retirementtaxservices.com and download the Desktop Tax Guide. This is a must-have resource for every financial advisor committed to tax planning.
Information designed to change lives. Financial planning can make you thrive. Start today, don't think twice.